Welcome to the ultimate guide to refinancing the mortgage on your investment property. But I'm going to walk you through everything you need to know step by step with zero fluff and no confusion. We'll start with the basics, what refinancing is and why it matters, and build up to advanced strategies, hidden costs, tax implications, and portfolio level tactics. Whether you're new to investing or managing multiple doors, by the end of this video, you'll know exactly when and how to refinance for maximum financial advantage. Mortgage refinancing is replacing your current mortgage with a new loan, typically with better terms. But here's where it gets powerful. You're not just lowering your rate, you're resetting your debt strategy. There are three main refinance types: rate and term, cash out, and streamlined refinances. Each serve a unique purpose, from improving cash flow to extracting equity without selling. Real estate investors use refinancing as leverage, recycling equity from one property to acquire the next, multiplying returns without new capital. Well, first, let's define the core value. Refinancing is about adjusting risk, cash flow, and long-term wealth simultaneously. Done wrong, it can lock you into higher lifetime interest, trigger tax complications, or limit your borrowing power. Done right, it's a multiplier. For example, turning a 5% adjustable mortgage into a 3% fixed rate can stabilize cash. Turning a 5% adjustable rate into a 3% fixed rate can stabilize cash flow, protect against rising rates, and improve property valuation. If the property appreciates at the same time, you're building equity in two directions: debt paydowns and market growth. That's the compounding effect you want. We'll also touch on common myths that refinancing always saves money, which isn't always true. That is only about rates, also false, and that timing doesn't matter. Absolutely wrong. Market cycles heavily influence whether refinancing is smart or not. So we'll talk about how tax treatment differs between primary residences and investment properties, how depreciation interacts with refinancing, and how lenders see risk differently, depending on occupancy, loan to value, and credit profile. The refinance process breaks into three stages: preparing, choosing a lender, and locking your rate, underwriting, and closing. Let's expand each one fully. Prepping. Collected income documentation, tax returns, leases, bank statements, and an updated property performance report. Review your debt to income ratio, pay down small debts if needed, and run a cash flow analysis post refinance to ensure that the new payment supports your goals. If you're self-employed, expect additional scrutiny. Prepare a profit and loss statement and possibly a CPA letter verifying income. Choosing a lender. Not all lenders are equal. Some specialize in investment properties, offering better flexibility on multiple mortgages or LLC ownership. Compare not only rates but closing costs, prepayment penalties, and how they calculate loan to value. Some portfolio lenders can overlook minor credit issues if your overall financial profile is strong. Others are rigid. The right lender is the one that fits your strategy. Locking your rate. Market rates move daily. Locking your rate. Market rates move daily. Locking protects you from increases while underwriting and closing proceed. A lock period might be 30, 45, or 60 days. If the loan doesn't close in time, you might pay an extension fee or risk losing the lock. Some investors float rates hoping for lower numbers, but that's gambling. If you can make your deal work at today's rate, locking reduces risk. Underwriting. Here's where everything gets verified. An appraiser determines current property value, which sets your maximum loan size. If you're pursuing a cash-out refinance, this number determines your available equity. The underwriting will cross-check income, assets, liabilities, and property condition. Any discrepancies can delay or suspend approval, so accuracy is critical. And lastly, closing. You'll sign the new loan documents, pay closing costs, usually 2 to 5% of the loan value, and receive any cash out funds. From this point, your old mortgage is paid off and the new terms are active. Always review the closing disclosure carefully. Confirm that the interest rate, term, amortization, schedule, and payment amounts match what was promised. There are 4 primary reasons to refinance. Lower your monthly payment, shorten your loan term, take cash out, and eliminate PMI. Lowering payments improves cash flow, critical for investors funding renovations, acquisitions, or reserves. For example, reducing the $2,000 monthly payment to $1,600 frees $4,800 per year. Multiply across properties and you've gained a funding stream for expansion. Shortening the loan term builds equity faster and reduces lifetime interest. A 30-year loan at 5% refinanced into a 15-year loan at 3.5% might raise monthly payments slightly, but in the long run, you save thousands of dollars over the loan's life. Cash out refinances turn idle equity into active capital. You can pull $100,000 from a property to fund a down payment on the next deal, upgrade units to justify higher rents, or pay off interest debt. Increasing portfolio ROI, eliminating PMI lowers expensive. Private mortgage insurance can add hundreds per month with no benefit to you. If appreciation and paydown have pushed you above 20% equity, refinancing may remove PMI permanently. Each reason has timing considerations. For example, taking out cash outright before a market downturn can stress your portfolio if values fall. Lowering payments at the cost of extending your term might save cash now, but cost more long term. Every move must align with your existing strategy and your risk tolerance. Discount points are upfront fees paid to reduce your interest rate. 1 point equals 1% of the loan and often lowers the rate by roughly 0.25%. Whether to buy points is a math problem. Well, first, you need to divide the cost of the points by the monthly savings to determine how many months to break even. If you'll hold the property beyond that, it might be worth it. If not, keep your cash. Amortization describes how principal and interest are paid over time. Early payments are mostly interest. Later payments mostly are principal. Refinancing resets amortization. So if you've been paying for 10 years and restart with a new 30-year loan, you'll slow equity build. Sometimes investors intentionally extend terms to maximize cash flow temporarily, then refinance again later in the short terms. Advanced investors use amortization strategically, aligning paydown schedules with planned sales, 1031 exchanges, or partnership dissolutions. Others use interest-only periods during heavy renovation phases to conserve cash. Both require precise timing and discipline now. Before you refinance, analyze property value, credit score, debt-to-income ratio, long-term plans, and PMI status. Property value determines equity and loan size. Lenders usually require 20 to 25% equity for investment properties. If you're below that, options shrink. You can wait for appreciation, make value-adding improvements, or pay down principal faster. Your credit score affects your rate. The higher the score, the better the terms. Pay every debt on time. Avoid opening new credit lines before applying for a refinance, and reduce utilization. Debt-to-income ratio shows lenders your capacity to repay. Aim for housing costs under 28% of income and total debt under 36%. Paying down resolving debt can move you into a better loan tiers. Long-term plans matter. If you'll sell within a year or two, the closing costs of refinancing may justify the savings. Conversely, if you're holding long-term, locking in a low fixed rate can protect your portfolio from rate hikes. Check for prepayment penalties on current loans. A large penalty can wipe out the benefit of refinancing. Also review occupancy clauses. Some loans require the borrower to live in the property for a period, which may suit investors. Refinancing isn't just a transaction, it's a strategy. So when done with clarity, precision, and foresight, it can accelerate your path to financial freedom. Always run the numbers, model best and worst case scenarios. Consult your lender, your tax advisor, and if needed, your attorney. The goal is to make your money work harder, your risk lower, and your portfolio stronger. And that's how smart investors turn refinancing from a simple rate adjustment into a powerful wealth building engine. Thanks for watching, guys.